we're going to get into it, and you're going to be taking us through three or four charts, and we're going to be starting with a bit of on-chain, and then we're going to go into some kind of liquidity and broader issues. And I think there's a bunch of questions that are going to come out from all of this. So I'm really interested and intrigued because you come at this data very differently, really, from anybody else in the space. And a lot of this is your own custom content. And so I'm keen to get started. So I'm going to let you share your screen.
Yeah, so what I thought I might do just before we get into the on-chain data, I think it's really helpful to sort of frame why Bitcoin is important and how it sort of fits in within sort of the macro landscape.
Yeah, great.
So I thought what I might do is if I just bring this up and you can hopefully tell me whether that's all clear on your end.
Yep,
Can you see
all good.
that? Okay. Talk about sort of liquidity because
Okay.
it's if you're following Bitcoin, you're always seeing liquidity being used as a reason for Bitcoin either rising or falling. But the term liquidity is probably, I mean, it's defined differently by different folks and depending on sort of the way they look at the markets. But essentially, liquidity represents a couple of things. It represents the, I guess, the credit in the system, how much, how easy it is for banks to loan and to provide their credit functions. It is determined by the level or the rate of money, the price of money, which is essentially the interest rates that the central banks set for the economy, and it also includes like the volatility of the collateral of the global economy, which is really US Treasuries. So we live in a fiat fractional reserve system. It's a debt-based system. The collateral of the system is US debt. And so all of these things sort of describe liquidity. So you can look at it through a couple of different lenses. And the first chart that I'm showing here is looking at two things. The first thing is central bank balance sheets. And so that's the blue line on the screen here. So we're looking at central bank balance sheets from 2010 all the way to 2023. And I've just overlaid the Bitcoin price. Now, we can see that both of these have gone up over time. You know, if you're a quantitative or statistical sort of minded person, that doesn't necessarily mean causation, right? They've actually increased over time, but just one caused the other. And I'll come to that in a little bit, but it's very clear that central banks have added more stimulus into the global financial system because their balance sheets have been expanding. That means that they've been buying assets from banks and financial institutions. Usually it's sovereign debt. In some cases, such as in 2020, they went to extraordinary measures and even bought corporate bonds. They also own mortgage-backed securities. And by doing that, that actually frees up the bank's balance sheets so they can continue to conduct their normal everyday functions, which is to lend, provide credit into the economy. And so we can see that the central banks have played a increasingly large role in the global economy. If I took this chart back over the last 40 years, really we can see that the rate of change of the balance sheets has actually accelerated in terms of it increasing over the last decade. So we're in very extraordinary times. And so with that, you know, you had in 2009 the birth of Bitcoin. And so Bitcoin was really a response to a couple of different things or a couple of different needs. One was the issue of constant debasement through a fiat-based system or a fiat-based credit-based system, because there's nothing tethered. The currencies of the world are all fiat, so they're not tethered to anything physical or scarce. They can be printed into oblivion, and through every new loan that's issued by a commercial bank, that's new money entering the system, and so there is a constant debasement that's taking place. That was, one of the, I believe, one of the notions behind Satoshi's work. But the other thing was really, a way for people to transfer value without a centralized third party or an intermediary. And so the problem that we're seeing today is this ever growing centralization of governments, whether it's at the national level or whether it's at the global level, and increasing censorship or freedom of expression, freedom of movement. The Bitcoin network is a censorship-free way to transfer value, whereas the fiat-based system is very much restricted and becoming ever more so. And the unit of account in the fiat money system are dollars, or the fiat currencies of everyone's national or wherever they live, which country they live, which is constantly being debased because that is the way a credit-based fiat system essentially works. So when you look at the financial system, really Bitcoin is a byproduct of what was happening even before the GFC. And ever since the GFC, the reason why Bitcoin has become more valuable is because we can see that the trends that were in place have only accelerated ever since. And so there is a very close relationship between global liquidity or debasement that's happening and the price of Bitcoin, the asset. And so,
yeah, can I ask some questions, or you want to keep
sure.
going?
No.
Okay.
Yep.
I want to ask some really basic questions. I'm going to ask, which of the 6 central banks as a starting point that this is based on?
The US, Japan, Bank of England, Europe, China, and did I mention Canada? Did I mention Japan? It's either, so BOJ's in there. I can't remember whether it's China or whether it's Canada in this series.
Okay, all right. So that blue line is referring to, say, so it's the combined assets of all of those central banks, which is predominantly, as you said, Treasury bonds, but also some corporate bonds they got into, and even mortgage-backed securities. So it's all of that stuff. It includes gold, because I understand particularly China owns quite a bit in the way of gold in their reserves, is my understanding. So that fast acceleration in 2020, that's obviously the COVID money printing via the issuance of greater numbers of treasuries. So,
This was so I would just say that the response that we saw in 2020 and 2021 was really the central banks aggressive for debt instruments in the economy. So they took a lot of debt off the balance sheets of the banks and replaced them with essentially bank reserves, and that provided liquidity to the banks. And so, yeah, the response that we saw in 2020 was unprecedented in nature. And if I was to show you another chart, which I won't, but another chart of just the money in circulation, right? So M2 money supply, which is a reflection of the credit issued from banks, that also responded to the interventions from central banks. And over the 2020 period to 2022, the number of currency units, because this doesn't represent currency units, this is essentially financial liquidity to the banks. The banks then issue the currency or issue credit into the economy, and that shows up in M2. But that number increased by about 40% over 2 years, and it was the largest year-on-year increase that we'd seen for many, many decades. And so obviously that's played into what we're seeing today with inflation. There was just much more currency that was issued at that time. And all things being equal, that just means that the price of goods will naturally increase. So it was such a massive response at that time, really unprecedented.
Absolutely, and that's something we talk about quite a lot in the Bitcoin community, and that the rest of the world seems to have trouble picking up, because what we forever hear is that inflation is caused by price gouging, which is one of the discussion points on Twitter I can't go anywhere near because it drives me mad. With the issue of Treasury bonds, help me understand this. So, in effect, they're basically foisted on the commercial banks as thou shalt take this, thou shalt buy this from us. Yeah. So the banks
Right.
don't have a choice around that.
Yeah, I mean, if you're one of the banks that are, in the closed sort of community of that the Fed uses to basically buy the debt, they will buy it. They have to buy it essentially, but then they sell that on to other participants in the economy or keep it on their balance sheet. So they're a sort of pass through mechanism.
Who wants treasury bonds anymore?
Well, certainly not foreign governments, not unless,
Yeah,
I mean, everyone wants an asset at a certain price. So at the moment, we've seen, the two largest buyers of US treasuries, which was China and also Japan, either start to really, pull back on those purchases. And in the case of China, that's been sort of a policy of theirs since 2013, 2014. Um, so there is a dwindling number of buyers at current levels. That may change, right? So I mean, if their interest rate was 9%, then you might see a little bit more interest in the product itself, right? There's always a buyer at a certain price, but obviously the US government can't allow that to happen given the indebtedness of the US government. So at these levels, there doesn't seem to be as much interest as ever before in US treasuries. And that's a real concern for the government, for the central bank, and is the reason why at some point we will likely see, and at least in my view, the central bank have to step in and be the buyer of US government bonds in the same way as the Bank of Japan is the buyer of their debt, JGBs.
okay. Yes, indeed. So the drop off that we're seeing from, say, the beginning of 2022
Mm.
uh, in the liquidity, is that a reduction in assets or is that a deceleration of growth?
So it's actually a reduction, and they do it via two ways. They either sell the assets or they let some of their assets roll off, expire. And
Right.
so it's been a combination of both of those things. And so we had a similar episode in 2018. If you can see
Yeah.
back on the chart there, there's 2018 where they conducted quantitative tightening for around 2 years or a little under
Yep.
2 years before they
Yep.
had to step back in. And what's interesting is that after such a small reduction, if you look at the rate of change of the balance sheet over the period of 2010 to 2018, and the period where quantitative tightening took place, and how small that was relative to the increase, and what had to follow was something even larger in terms of an increase. So you're starting to see like these very large accelerations to the upside after they try to pull back or after they try to withdraw liquidity after some period of time. And so you'll also see on the chart, I've got another chart which makes this a little bit more clearer, but that peak in 2017 Bitcoin price coincides very nicely with the peak in the balance sheet, the global balance sheets of 2018 as well. And so the bottom also sort of coincides pretty nicely with the turnaround in monetary policy as well. Now, the top in Bitcoin in 2021 came before the peak in the central bank balance sheets, which was a little bit later. But if you remember back to 2021, it was as clear to everyone who wasn't a Keynesian economist that they were going to have to tighten because inflation was well above their target levels. And obviously, the money printing and the central bank interventions were having, an effect which I knew at the time. And, people who have any common sense would understand that what they did was always going to cause inflation. But the mainstream economists were ignorant to the fact, or whether willfully or, just really were completely oblivious to the realities of economics. And so I think Bitcoin topped in 2021 ahead of what the market knew was coming, which was tightening. Now, the Fed didn't actually change policy until Q1 of 2022. But that's why Bitcoin is such a fantastic barometer for global liquidity, because I think Luke Roman was the person who coined this phrase, but Bitcoin is the last functioning fire alarm in the economy. It knows the subtle differences in changes in liquidity and monetary policy before you get, the 12 anointed ones from the Federal Reserve and the Grandmaster Poobah who gets up and talks every month or 2 months about interest rate policy, and tells the market what they're going to do. Obviously, the market is forward-looking and understands, and Bitcoin is the best barometer to understand monetary policy through.
The canary in the coal mine. Okay. So I'm just going to stick with the chart for a moment, and I'm going to state a couple of what seem like really obvious discrepancies. One is the size. Oh, I suppose this is logarithmic, but are they both logarithmic? So what I was going to say was the size of the increase of liquidity in 2020, mid 2020, versus the size of the escalation of the Bitcoin price don't seem in proportion. What's that about?
It's a very good observation, Carolyn. I'm just changing the right-hand scale, which is the central bank balance sheets, to a logarithmic chart as well.
Oh, right.
So you are looking at both of these axes. And the only reason I didn't actually change that right-hand scale was just so that it became so much clearer to the viewers about how big that change was. But even on a logarithmic scale, here you can see that it was unprecedented. So the percentage change, the speed of change, the rate of change was so much more aggressive in 2020 than even the previous sort of 8 or 9 years, despite the fact that that period was unprecedented if you look back the previous 60 or 70 years.
Right. Which we'd have to see. Have you got that anywhere?
I don't have the long-term chart because the time series doesn't go back that far, unfortunately.
Fair enough.
But what I can do is maybe if I could just bring up this chart here. Okay, so this is just another way of visualizing that same data, but I'm just going to make it easier and only focus on 2 time series. So this is the same time series as the previous chart, but instead of looking at the nominal change of both, we're looking at the rate of change. Right. And so it's not perfect, but you can see that when the blue line starts to increase, so when the balance sheets start to expand, Bitcoin starts to also increase. So you get the bottoms almost within a couple of months, you get the tops within a couple of months of one another.
And this is US only, yeah?
This is, again, the central bank, the US, the G6 central bank balance sheets.
Oh, G6. Okay. Yeah,
gotcha. We're looking at a 12-month rate of change rather than just the nominal value of those indices. Yeah. And so, you can see how aggressive the run-ups are in Bitcoin relative to the liquidity responses. Except for 2020, that was like the response from the central banks was even greater than the response of the Bitcoin price. And we, end of 2022, so Q4 down here, what happened? The degree in which, so this is measuring the rate of change. So it's not saying that the central bank balance sheets have stopped contracting. It's saying that the speed of the contraction has decelerated. And that is essentially all it takes, because then you're starting to see the end of the or the light at the end of the tunnel for this phase that we've gone through of extraordinarily tight liquidity. So when they started contracting, they contracted very aggressively in 2022. QT was at a certain rate. Interest rates went from 0 to sort of 3-4% very quickly. So the rate of change was so sharp and so severe, all assets sold off very aggressively. And obviously Bitcoin and the entire crypto ecosystem did as well. But as soon as we started to see that deceleration and start to see that the central bank balance sheets, whilst it was still declining, stopped declining so fast, because what happened in Q4, which some people might not be aware of, is that Bank of England had a crisis and England had a crisis, Japan had a crisis. And in both instances, their central banks actually reversed or intervened to basically save their sovereign debt market. And it didn't get as much airplay, but that also signaled to the market that the end game is in sight, that the central banks, because of the level of sovereign indebtedness, can't allow their sovereign debt markets to explode or to crater. And so they had to intervene in both occasions. And that was just enough for assets to basically bottom. It wasn't just Bitcoin. There was the S&P and NASDAQ rallied all throughout this year. It's just that obviously Bitcoin is this hyper volatile asset. It has asymmetric returns, and it obviously outperforms other assets when liquidity increases.
Okay, understood. So, what I find interesting about this is, well, there's many interesting things about this, but I guess the question comes into play. It's almost like we've got adoption and that S curve of adoption of new technology, and therefore number go up in in relation to that as a growth asset, but then it's being impacted on the other side by this correlation with liquidity. Do you see a decoupling between those over time?
Yeah, so you're absolutely right. There's the structural trend that's taking place, which is technological advancement, blockchain technology being adopted, Bitcoin being adopted as a store of value and for the various monetary qualities that it possesses. But you can see no matter what the adoption is, it's still very closely related to the liquidity cycle. Because at the end of the day, what is the use case? The use case is a censorship resistant medium of exchange, but also a store of value. If we lived in a world where we had a currency which tethered maybe back to gold or a basket of commodities, and our governments weren't able to spend as liberally as they do, and the amount of credit creation wasn't as high as it is today, the level of debasement wasn't as severe as it is today, you could argue that the case for Bitcoin is somewhat more diminished. So whilst the temporal relation, like the time-based relationships between liquidity and Bitcoin may change over time, I think that, and maybe in a way that actually will, I've written about this as well. It won't take as much monetary stimulus in the future for Bitcoin adoption to still continue, because effectively what Bitcoin needed in the very early stages was central banks just to do central banks, right, to do their thing. So the way I think about it is that basically central banks, ironically, have bootstrapped the Bitcoin network. They brought in millions and millions of people into this alternative monetary system, this alternative store of value, as a protest vote against them. And even if they self-correct, they reform, which is extremely hard at this point in the debt cycle, even if they do, it's almost too late. Bitcoin has reached escape velocity. So we don't need a 2020 COVID stimulus response for this asset class to go up. It just needs to basically, to reverse the current tightening. And it will have to, because interest payments from US debt by the US government is now over $1 trillion and is reaching the point where they're essentially issuing new debt to pay off the old debt. And so that's called a debt spiral. I know you've spoken to James Lavish, who does fantastic work around this. And so they will have to intervene in my view. And so, great, that's good for Bitcoin. But it doesn't need as much as it has it doesn't need as much liquidity as it has in the past, is the point.
If or when do we see the central banks starting to put Bitcoin on their balance sheets?
We won't see it from any of the G6 countries for a long time, I don't think. But the countries that have got more to lose in the current financial order are the ones that will likely look to adopt. And it's funny because it sounds so fanciful. And even now, you talk to mainstream folks, they'll say it never happens. Well, it's a more than 0% chance. We've already seen, a nation, two nation states, as insignificant as they are, already do it. And so 6 years ago, that would have been inconceivable. Now we have two. But the interesting thing is you've almost already got it through a sort of, a de facto policy, which is around energy. So let me explain that. We've got three countries in the Middle East, several now in South America, and a couple in Asia, which are mining Bitcoin as a national energy imperative because they may have excess energy, they may have stranded energy. In the case of the UAE, they have overbuilt their grid. And so what I mean by that is they've got nuclear power, they've got solar, and they've got a lot of gas. And so in their economy, which is the polar opposite of economies like ours here, Carolyn, where our national policy is to underdevelop the grid, and which is causing unbelievable price inflation in energy from unreliable energy sources and the throttling of abundant, cheap, dense energy and the reluctance to adopt nuclear energy. These countries have so much energy that they're trying to monetize it. And by monetizing it and putting Bitcoin miners on their grid or behind the meter, they effectively lower the tariffs for the citizens of that country. So they enjoy, abundant energy, cheap energy. And what is that doing? That's bringing in businesses. It's growing their economy. And so if they are working in partnership with private companies or even state-owned enterprises that have got mining rigs, well, part of that inventory is Bitcoin. And most Bitcoin miners sell the Bitcoin to cover the costs and to realize that the main objective is to raise fiat. But essentially, you've got countries now with Bitcoin mining as part of their strategic energy policies. And so de facto, they've basically invested in Bitcoin. They're putting it on their balance sheets. It's not as direct as a central bank owning it as a reserve asset, but it's a very important step. But in terms of like central banks putting it on their balance sheet, any economy, any small emerging economy that's being ravaged by inflation that is essentially just, it's interesting what Malay is going to do in Argentina, but if you're a country that's got your currency pegged to the US dollar, you're at the whim of US monetary policy, and obviously they're heading into some form of a debt spiral. And so, for them, they've got far more to lose. They don't have control of their monetary policy. So one thing they could do is put Bitcoin on their balance sheet, and it's really a question of position size. So I don't think Bitcoiners are saying go out and basically just replace all reserve assets on the central bank balance sheet with Bitcoin. Some might, but I think that's a bit extreme. But maybe that's the same sort of approach that personal retail and investors like us approach. It's like maybe it's 1%, maybe it's 5%, maybe it's 10%, maybe it's more, who knows? But the question is, you got to get off zero. And so I think we'll see over the next 4 or 5 years, smaller countries that have got far more to lose take a position on Bitcoin.
So the small countries, particularly those ravaged with inflation, there's a really obvious use case. Russia, because of the whole SWIFT debacle, has got a really obvious use case. I haven't thought quite so much, and I should have done, about the Middle East, but of course the whole petrodollar thing is again to get out of the petrodollar and to have an alternate currency. I don't know that the BRICS nations more broadly could agree on that. But I can imagine one or two countries within the Middle East being attracted to it or to the idea of trading in it, given a lack of trust necessarily for each other's currencies, but an interest in having a neutral third-party currency. What's your insider knowledge or understanding or research around that?
Well, I think that Middle Eastern countries that have developed two things. They've developed an interest in Bitcoin mining. So I would see that as an intermediary step, potentially to owning it on their balance sheet. But they've also introduced fairly progressive regulations around crypto in general, so not just Bitcoin. So they kind of see the whole space as an area of innovation for their economy. And so countries that get familiar with the industry, that bring Bitcoin mining in for whatever reason, whether it's stranded, whether it's excess, whether it's to subsidize renewable projects which have lower ROI, which they do, especially in countries where it's not natural to have it. These are all intermediary steps. And so the Middle East seems to be ahead of the rest of the world. I mean, you've got other small countries that are doing this. You've got El Salvador with volcano mining, and I think they've also maybe got some solar projects or wind projects as well, which they're attaching adjacently to Bitcoin mining. And Bhutan's got this massive hydro asset, which they're monetizing with Bitcoin. So, but it's certainly, when you think about, like, of all those countries, which ones are sort of leading the economic growth and innovation sort of charge globally? The UAE is becoming a very important center globally for global capital. And so you can see it sort of just evolving naturally there.
Hey everyone, have you yet checked out the incredible, groundbreaking new Real Vision platform? See, we've built something that allows you to live your financial life in one place. We bring together the knowledge, tools, and network to help you thrive in your financial journey. We've got AI tools to help expand your knowledge. We've got courses and education. We've got note-taking. We've got pricing and charting. And in addition, we've got obviously the world's best content, both on macro and crypto, to bring everything together. And in addition, you get access to the Real Vision network. That's our tens of thousands of members across the world, where you can connect and chat to them about what really matters to you. Anyway, it's free, realvision.com. We'll see you there.
Okay, fantastic. Let's move on from here then. Let's get into, of your choice, which was it the Onchain that we wanted to have a look at as well?
Yeah. Let me just bring up this dashboard. So hopefully that is clear on your end. I'm just, so I've talked about some of the macro drivers, which are critical. If there wasn't the macro reason for or the conditions in place, Bitcoin wouldn't be as valuable as it is today. So once you sort of establish why it's necessary, then what I try to do is look on chain to see how healthy is the Bitcoin economy. Right. So Bitcoin it's a monetary network. It's a way for you and I to exchange value that is centralized or intermediary, and to do so relatively quickly and relatively cheaply. And so there's that aspect, and then there's the aspect of holding this digitally scarce asset with a cap supply. And these two forces are what sort of drive the value of the network. And so I break it down in as simple as approach as I possibly can. There is unbelievable value within on-chain data and creating lots of different custom metrics, some of it for trading purposes and for the investment community to look at and to sort of derive alpha from. But what I'm trying to do is tell the story of just, if this was an economy, is it healthy? Is it growing? What are the things that are either concerning or not so concerning or very, very positive? And try to marry that to what the price is doing to say, okay, it's undervalued or overvalued. And so all I've done here is I've broken the what I call the adoption drivers. So I look at the number of users and how it's being used. I look at the transactions. So, maybe if I just focus on the users here before we go to the other sections, but the number of active addresses or the number of people actively using it. So transferring value more than once a day. Okay. So then that number is just shy of about 1 million. If we look over the last 12 months that active addresses is up about 10%, but it's actually around 13% below where it was 3 years ago, right? So a little bit of stagnation on the network over time, but generally pretty positive performance in the last year. And so the next one I just want to point out is the number of non-zero balances. So you can just think of this as the number of people, the number of addresses that own Bitcoin. Yep. And I use the word people or person when I describe addresses, but they're not really the same thing. It's just a proxy. So an address can represent thousands of people, tens of thousands of people, and one person can represent multiple addresses. It's more likely that this is an underestimation of the number of people by many factors, maybe 4. So when we look at number of non-zero balance addresses of around 50 million, we're probably looking at a number of about 200 million people that have exposure to Bitcoin. And so that number the number's at all-time highs, right? It's in the 100th percentile ranking of its entire history, and it's up about 16% on the last 12 months, and it's up about 53% in the last 3 years. So what's this telling me? It's that the high-frequency activity on the network for moving value, in terms of the number of addresses, that's actually sort of stagnated over 3 years. I mean, it's not down by a great deal, 12, 13%. But the number of people who have bought it and have created an address, that has just consistently gone up, irrespective of price, irrespective of the 70% drawdown that we saw in the last year. That just marched higher every month, month after month, month after month.
So are we talking about hodlers versus transactors, people actually using it as a medium of exchange? Is that the difference here? Why one's
somewhat, but somewhat, but there's a better way to measure that. So there's a term called accumulated addresses. So if anyone follows on-chain data, there's things like long-term supply. So addresses that have held the Bitcoin for more than 6 months versus the short-term supply. Yeah. And so that's a great way to measure, are people hodling? And that number is also up and to the right. It's at an all-time high. I use something called accumulation addresses, which is an address that has received Bitcoin twice, not just once. It's received it twice and never sold it.
Right. So
that number is pretty much at all-time highs. It's in the 99th percentile. So there's 856,000 accumulation addresses. So there's lots of different ways you can look at it, but all of those metrics, Caroline, if you're trying to understand what a hodler is doing, they are all at all-time highs. So they were completely price agnostic. They didn't care that Bitcoin fell. They continued to do what they've been doing for the last 5 or 6 years and buy Bitcoin, add to their Bitcoin stack. But the number of the economic value, which is really captured more so in this next section called transactions, that's a slightly different story. So the number of transactions on chain is really quite close to all-time highs. So that's about 537,000 each day on the Bitcoin network. So I mean, these are pretty decent numbers for a decentralized grassroots monetary network. It's doing pretty well. In terms of transfer volume, it moves about 2.24 billion every day. And that's reasonably high, 96th percentile. But it is sort of, it is down about 60% from 2021.
Yeah. Okay.
Now,
and this is all, of course, on chain. This is all, of course, on chain. So therefore, it's not taking into account what's going on Lightning. Yeah.
Exactly. This is all on the base chain. Absolutely. Lightning is having an impact here. It's hard to quantify that, but more value transferring on Lightning is value that's not transferring on the base chain. So it's starting to impact these numbers. So that's definitely a consideration when you're looking at it. But essentially, I guess the story here is that transactions are up, transfer volumes are down on where they were 3 years ago, and the median transfer value, the size of the transfer, is actually, at rock bottom levels, 21 cents. And so the reason for this, because it doesn't make sense when you first look at it, number of transactions are up, but the transfer volumes are kind of down. But the medium transfer is like way down at all-time lows, or thereabouts nearly. And that is the impact of the block space being used a lot more for ordinals.
Oh, right.
That development really screwed up the on-chain metrics this year because they came out of nowhere, a brand new use case for block space. People are using the block space for ordinals, but the average ordinal transaction is very small. And so that's impacted the median transfer value, the transfer volumes as well. And it's also just coincided with still a year where, we're still coming out of the bear market. So what we'll see in the future, it's very hard to tell. But yeah, I think as activity for the primary use case of blockchain, which is Bitcoin, which is to transfer value, as that increases and that takes up more of the block space, fees will increase and it will be just a little bit more expensive for the ordinals transactions on the network, and that may decline. And that's just if Bitcoin follows its usual cycle where prices go up, more on-chain activity, fees go up in response, and that just sort of consumes block space. And so these less economically valuable, I'm not saying that they're worthless, like that is a completely subjective term. Like this network can be used for many different things, like storing data. WikiLeaks have put their files up on it. It's a transparent accounting ledger. So there is no right or wrong, but economics will come into play when it's advantageous to use it for certain things. And so this year, because volumes have been and values have been low on the network, not as much has been moving. Ordinals have come out of nowhere, and that's been great for miners because it's given them extra fees that they otherwise wouldn't have had. But it may change as we get into this bull cycle.
Okay. I am not going to ask any questions around that because I simply don't understand enough about ordinals and how they work, and I'm sure plenty of other people would have a whole bunch of intelligent questions for you, and I just don't. Sorry.
Well, I haven't used ordinals and I'm not into NFTs. Not until we start to see NFTs around music a little bit more because that's my thing. But yeah.
Right, yes.
But you can see it on chain. So again, like it's just one of the wonderful things about this data set and about this asset class. You don't get the real-time analysis of what's happening on networks like Facebook or Amazon until the quarterly reporting, of their earnings numbers. Whereas, we've got a global decentralized ledger, which is completely open. We can see, with a 10-minute update, and that's wonderful from a research perspective.
We can't tell. Can we tell the geographics of wallet addresses or not?
There's been work done on it. So I can't remember the methodology that chain analysis have applied. So chain analysis do a crypto adoption annual update, and it's not Bitcoin specific, but they do look at data which is like your IP address. So it's not perfect, and it's a little bit creepy.
Yeah.
But IP addresses, if they're public, everyone's using it. But the IP address doesn't necessarily tell you the accurate underlying story because people use VPNs.
Exactly.
So it's really hard to tell. The other way to sort of analyze it is to look at the UTC timing, universal timing, and look at when Bitcoin transactions increase and decrease over the course of 24 hours.
Oh, I see.
And you can map that to the geographies. So I've done this with Tether.
Okay, because time zones, because when people are awake. Okay, gotcha.
Yeah. So you can sort of see, like with Tether on the Ethereum blockchain, tends to see its largest surge in activity at the end of the Asian day leading into the Middle East, leading into India, Middle East, Africa, up into the European Open. And so from that, I've just been able to sort of, ascertain, it's not, exactly scientific, but it's a guide that there's a lot of Tether usage happening out of Africa and Middle East and, and Asia as well. So I haven't done it for Bitcoin, but it has been done.
Okay. Cool. All right, let's talk fees because everybody's well, because I actually heard a really interesting presentation on the weekend about what we might expect with fees as time goes on. So, can you run us through a bit about this?
Sure. So, just in terms of what the numbers are saying, we've seen a very sizable uptick in fees over the last 12 months, which is great because fees are part of the security budget or the payments that the miners receive to incentivize to secure the network. So, and some of that is definitely ordinals related. They've just provided a new use case for the blockchain at a time when it wasn't being used as much as it has been historically, at least at this, the first 6 to 9 months of 2023. So we've seen a real pickup in fees. Some of that is due to the Bitcoin price as well, because it's priced in it's priced in Bitcoin, and the Bitcoin price has gone up over 100%. But you can see that fees have gone up even more than that, and so there has been a general uptick in usage on the network this year, and that's been expressed in fees, which is great. And so we can also see that the hash rate is, at nearly 500 exahash, 99th percentile. I actually say that the hash rate is the best indicator for Bitcoin. It is the one, if I was left on a stranded island and there was only one metric that I could look at to understand whether Bitcoin was healthy, it would be the hash rate.
So, why is that? As someone who really has never deeply understood, I mean, I understand what the hash rate is referring to, but why is it the sign of health? The sign.
Because miners have to spend capital in order to participate as a miner on the network. So they can only do that if there is an incentive to do that. So it's a signal that this network is valuable for whatever reason, whether it's just they believe the price will go up, or it's providing a real world service, and they're prepared to put billions of dollars of capital to secure that network and make it strong. And so if everything else was, if I was not able to look at any other on-chain data, then I would just want to know that that is the core underpinning is the proof of work consensus model. And so that is being supported by real capital moving in and doing the work, that proof of work, to process the transactions and keep the whole network running. Because without it, there is no network.
Okay, I get that. So it's the health of the network. I suppose what the conflict always is in my mind when I hear people say that and give a lot of emphasis to the hash rate is we can have a healthy network, but unless people are adopting it, unless we're getting demand for the end product, as it were, then does it matter how healthy? I mean, we always want a healthy network. We always want a secure, decentralized network. But isn't it more about, I'm interested that out of all of these metrics, and you've gone through adoption, but hash rate is the one that matters most to you? Because in my mind, adoption is more critical at some level. Maybe, unless I'm just thinking in terms of number go up, or using it as a medium of exchange across the world.
Yeah, I mean, they're all interrelated, and it's really hard to disentangle all the metrics and say, right, this is the one that matters the most. Like I've actually done like linear regressions. So just looking at the relationship of the price to all these different metrics, which one explains the price better. And you've got some metrics which explain price reasonably well, others that do not. Active addresses is a very strong metric. Hash rate and difficulty are very closely related as well. So just from a statistical standpoint, but then you've always got to step back from the stats and say, well, what is it actually telling us? And so when you've got the hash rate going up from early adopters now to nation states, they're effectively flagging. They're effectively forward looking and saying, hey, this is serious. We are going to invest capital, private enterprise first, now nation states. We're investing in this because, this network has value. Whatever reason they may use to describe it, the best signal is capital, right? That's essentially your pure signal, and capital's flowing in to support the network. And so, I might get a little upset that I don't see active addresses going up as much or transaction values going up as much, but I feel a lot more comfortable knowing that billions of dollars are going in to secure the network.
Oh, that was a real penny drop moment for me. Thank you. That's great. All right, got it. All right, tell me about this Z score, because I've seen this before as well, and I'm sure I've heard Checkmate talk about it, and I don't know very much about it.
Yeah, it's just another way to sort of represent where the price is relative to the on-chain fundamentals. So is a price deviated a long way from what the underlying adoption metric is saying? So in the same way as we look at, when we look at companies or equities, we usually use multiples, a price to earnings multiple, a price to book multiple. They don't necessarily have like an exact correlation to performance, although there is in this case, but those relationships change. It gives you a sense of where the network value is, the price, relative to that adoption rate. And so the Z scores here are 1.9 and 1.2, which is just saying price to active addresses is about 1.9 standard deviations above the mean, so above the average. So price is more expensive than, or the network value is more expensive relative to the active addresses when we look at it over sort of a 1 year period. And so is the MVRV, which is, you have to break this down a little bit. MVRV, market value to realized value. So the market cap to the value of all the coins last moved. And so that kind of gives us a cost basis. I'm sure James has talked about that. He is definitely the guru on chain metrics. So they are trading above their average, but when we look at them historically, they get very high in the bull markets. And so the color coding here is just an easy way to say, hey, it's a bit expensive, but it's not anywhere near the troubling levels that we've seen every single market peak. And I can maybe just help visualize that here on this chart. If we look at this one here, so this is MVRV in pink versus the price. And you can see the red line represents 6 standard deviations. And so once we get into those sort of kind of scary levels, those eye-watering levels where, let's face it, when you're at that level, most people who own Bitcoin are in a profit. And so when you've got so much profit-taking potential in the price, you're going to start seeing profit taking. It's just a matter of time. Like there is gravity that exerts itself in all assets, in all prices. And so when you get to those levels, it's time to sort of start. If you're a hodler, maybe it doesn't matter. But certainly if, the traditional finance industry looks at assets, they look at, trading them, they'll start looking at these metrics that, on-chain guys have been looking at for a long time and, adopting them into their mix. And so that may change the relationship over time. That may mean that we don't get to 6 standard deviations this bull market because profit taking comes in. So there's, none of these things are static, but it's a very good way to sort of see where we are in relationship to where we've been in the past.
Have you plotted that against fear and greed as well? The fear and greed index?
No, I haven't.
I'm assuming it's got to be similar. It's got to have a high correlation.
Yeah, it's just, there's so many different ways to express fear and greed.
Yes.
But I looked at another metric earlier today, which was the percent of people who own Bitcoin who are now in profit with the price at 38%.
Oh, yeah.
Because there was so much volume traded in the 25 to 30 range over the last 2 years, that 80% of people on their average holdings, the average price of all their Bitcoin, are in profit. So unfortunately, the people that bought at 60 and didn't average in over the last couple of years, they're the 20%. but the network is starting to get into profitable area. But that's not generally a concern from a market sentiment standpoint. It needs to go a lot higher before you see, profit taking. Obviously, the people who believe in this network over the long term, over multi generations, they're not going to be selling, and the conviction's growing in that cohort more than ever.
How do you know that?
Well, the way that the network behaved in 2022. So we've seen in previous bear markets that actually active addresses will fall a lot. And also the hodlers will also, 2017 was this massive capitulation on the network. Like a lot of people gave up hope. And so I wonder if I've got that chart. Yeah, I've got the chart here. So this is active addresses. I'm going to, sorry, flick through. I know that's annoying, but this one here. Okay, so this looks at accumulation addresses. So let's just make this a little bit clearer. So these are the addresses which I like to use, or the proxy I like to use for hodling behavior. And so accumulation addresses, it's an address that's received some Bitcoin not once, but twice and never sold. And so look at the difference between the last the last two bull markets. In 2017 was this hype cycle. It was way too early for Bitcoin to go mainstream. You had an unbelievable retail frenzy. It peaked with price and it collapsed by about 25%.
Yeah.
Then it started to climb in the bear market and started to break out again. And it broke out before the bull market really even sort of started. But what happened in the last bear market of 2022 and 2023, it actually, with the price peaking, what did it do? It just went up. Wow. So, and it continued to go up. It actually went up a lot on the FTX collapse.
Huh.
So
wow.
the study of price is the study of supply and demand. And so even though price fell, the people that were accumulating maybe weren't whales because they weren't able to influence the price enough for it to have stopped falling during that bear market. But eventually the supply and demand moved more in the favor of the hodlers and a bottom formed because they kept on scooping up coins and not selling it through the bear market. Unlike 2018, when, basically there was capitulation. 25% of the hodlers went, I'm out, and left, and probably came back in 1 year, 2 years, 5 years later. Who knows? But this was a very different bear market. And so with each cycle, you're seeing a solidification of the resolve of the Bitcoin network to continue to buy and take supply and hold it for a longer time. Now, some of those hodlers are going to sell in this bull market. It's inevitable, whether it's, for personal reasons because they need the cash, or whether they lose faith in the network. But the characteristics of the last bear market tell me that, we've got a very strong network, at least from the perspective of this is a scarce digital asset and I want to hold it because I think we are going to be debased at ever increasing rates.
So many questions going on still. So we talked just before we hit the record button about ETFs and BlackRock in particular and their $8 trillion of funds under management and asset ownership, and the fact that they could, to what degree can they hodl and hoard, really, or the available Bitcoin supply. And related is the idea that, I don't know if do you know Peter Dunworth?
Yes.
Here in Australia? I thought you did. So one of the things he talked about on my show was the idea that anyone with a printer, so the central banks, if and when they do decide to add 1% Bitcoin to their treasuries, could just print money, buy Bitcoin. So you've got the potential for people like ETFs, so private and public, to just come in and mop up. What are your thoughts around that, please?
Well, we're going to see, we are going to see the start of this next year will be the start of serious traditional capital moving into the space, traditional finance, traditional investment institutions moving in. So it's inevitable that they are going to become far more prevalent in the network, and that's going to change the relationships of certain metrics and the way that we need to analyze it. But ETF, we don't have. It'll increase the opacity, I think, of the owners of the network as well. But I mean, it's the jury's out as to how, if they're able to do the same sort of things that they're able to do in traditional finance. So we pretty much know at this stage that gold is manipulated, that most commodities are manipulated by the cartel of banks that run those commodities. Like, there's certain banks that sort of are the primary banks or institutions which house certain base metals. There's the gold bullion banks. There's about 5 of them that sort of control the selling, the institutional selling of gold within the financial system. And of course, they're all private ledgers. We have no way of verifying, or there's no authenticity in what they print as their reserves or print as their inventory versus what there actually is. And we know for a fact that in many cases, it's not always what it is. And plus you've got the frequency of the updates as well. So, another example of that is like, we kind of have an idea of how much gold China has, but we don't really know exactly because they'll only provide updates on what the central bank has actually bought like every couple of years. So there isn't the transparency in the traditional markets as there is in Bitcoin. So I'm not sure or convinced yet, although I'm open to, persuasion, that there could be the same kind of shenanigans in the Bitcoin market because of the transparency that it provides and also the type of network that it is. Like, we demand proof, right? The exchanges have had their day in the sun of being basically commingling client funds with their funds and trading off the back of it. And the regulations are going to come in and sort out those centralized exchanges pretty quick. So that's going to clear things up. But in terms of the ETF providers, they'll have to disclose their holdings as well. But again, we're trusting those centralized intermediaries to do the right thing. So it's very unclear to me as to how this sort of impacts the market. On one hand, it's wonderful from a flows perspective and for legitimizing it. I'm not sure if the same kind of shenanigans will be conducted by BlackRock that an FTX did. Of course, that may sound ridiculous because BlackRock's a respected institution, but we just don't have the same level of transparency in the traditional financial markets as we do on Bitcoin. But we're going to see a marriage of the two. And you've got a very hypersensitive community of Bitcoiners, which will be, watching everything that happens on chain to see if there's any kind of funny business.
Yeah, okay, that's very true. I'm going to have to move us towards 2 things. I'm going to ask for a price prediction for the medium term and then for the longer term. And so let me just frame up the question around the medium term. So what I mean by the medium term is the current cycle. So, through the halving for the kind of 18 months to 2 years beyond the halving. So really, in effect, when we're expecting the next peak. So I'm going to ask for a price prediction for the all-time high in this cycle with 2 thoughts in common. One is, on the one side, you've got the Ben Cohens talking about, diminishing returns. On the other side, you've got people talking about this is the last time before institutions get in and we see crazy movement. So you've got a couple of different schools of thought going on out there at the moment. Where do you sit?
So I did the price projections in June. I said it would be 39,000 by November. It got to 38. And then I projected a range of 150 to 180. I actually had a base case or a sort of bear case of around 92,000, but the moderate to bull case is around 150 to 180, if I remember correctly. So that's just, and that is really not a very scientific approach. You look at what Ben Cohen talks about in diminishing returns. I sympathize with that understanding. As assets get larger in value, then in theory, the price moves become less on each new bull market because there's just so much more capital that it takes to move at 1%. When you're a $3 trillion asset versus a $500 billion asset. But, you know, it doesn't matter too much whether I'm right or wrong because, you know, I know that it's going to outperform other assets. So that's the most important thing. So I've only really looked out to the latest cycle and said, right, this is the return in the last cycle. It did about, I can't remember the numbers, but it was, you know, substantially less in the 2020. So from the 13-14 cycle into 16-17 into 2021, and just looked at that moderation of returns. That's how I got to my numbers. But I used sort of different sort of scales to get from sort of 90,000 to 180,000. And look, that's really non-scientific. Another way to look at it is what would active addresses need to be given the correlation of active addresses to the price be for Bitcoin to get to 180,000 in price. And we'd have to see active addresses get to about 1.5 million. It's at 1 million today. So that's a lot. That's a lot of new users to justify the price increase. But the thing that sort of makes that really hard to gauge the cycle is because you've got all this investment capital coming in that's not using the network, but is using an ETF investment vehicle, which could just basically soak up supply. So you'll get, you know, maybe not the sort of usage increase that you would normally think based on historical correlations, because people like, you know, our parents are buying it through some sort of ETF product. They have no intention of using Bitcoin. They won't show up on chain, but they'll show up in the BlackRock wallet for the ETF or whatever. So I just feel strongly that this is the asset for to protect yourself against debasement, and debasement is certainly the one thing that's constant. So.
Yeah, that's right. That's the thing, isn't it? We don't know what price Bitcoin is going to, but we do know the price that our current fiat is going to. I will ask, just for the fun of it, if we were to look out 3 cycles to sort of 2035 to 40, which for some people, if we're talking, you know, 12 to 15 years ahead, maybe some people are starting to look towards or hope towards retirement. What are your thoughts around that? Have you thought that kind of distance and beyond?
I actually try not to listen to Peter Dunworth when it comes to this question.
Absolutely understandable. He's got to be in the top 3 bulls in the space. Right?
I've never heard a price prediction as high as his. So I think he's.
I think Breedlove.
Oh, really? Okay.
Yeah.
Look, I hope they're right.
Maybe I'm wrong. Sorry. Yeah.
Yeah. Look, I mean, I sent out a tweet the other day. It was like, I think what we really want to hope for, because what does it actually mean if Bitcoin is $1 million in 10 years' time? Unfortunately, it means a lot of pain, a lot of anguish, and maybe a lot of deaths.
Right.
Because this system is killing us, and it is creating a massive divide in the populations around the world between the haves and the have-nots, which comes back to the underlying principles of Keynesian economics, fiat fractional reserve banking. And so there's a part of me that, you know, I would say more so than the get wealthy phase is like, you know, Bitcoin is trying to keep them honest. They're not listening at this point. Hopefully at some point they do, and we get some moderation of the insanity. So, you know, hopefully it doesn't get to 1 million in many respects, because at that stage, it just means the system, like, they've lost control. We've lost control. So yeah, it's important because that's why a lot of us are here. But yeah, I think in the meantime, because people in power don't recognize, well, they hardly ever admit fault. When they do, they'll never apologize, which is fine. I don't want apologies per se. I just want them to, I just want better policy. I want a better society. And so between now and that recognition by our policy leaders, and it'll take you, me, and everyone else to vote the right people in or get involved and be proactive, Bitcoin will be a lot higher in that time, and we will hopefully not see, complete chaos because of it. But I hope there's an inflection point where price goes up a lot, things start to change because it's a signal, or they, who knows.
Brian DeMint says something very similar about simply Bitcoin creates, because there's an escape valve, it puts a check or it puts some sort of moderation on the governments and the central bankers as they currently are, simply because there's an escape valve, there's a flight to value, flight to safety.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.